Do you ever wonder, what economic reports do we need to pay attention to, and which ones can we comfortably ignore? If that is a question that you have, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. Each month, we receive a wide variety of information in the form of economic reports. There are numerous economic reports that are released that measure various parts of the U.S. economy. Now, other countries also release economic reports, but what I will be focusing on in this video are just those reports released in the U.S. Typically, reports in other countries don't have a big impact. Sometimes they do, but that is very rare. The reports analyzed typically focus on what we call macroeconomics, or this is looking at the big picture of the U.S. economy, or the economy as a whole. That is opposed to microeconomics, which looks inside a specific company. It might look at their products, their management, their profits and losses. Well, this focuses on macroeconomics, so we get a much bigger picture. The reports that are carefully analyzed are those that can impact the financial markets. Some of these reports are very important, and the market waits with anticipation to hear what these reports have to say. Others are released and it doesn't have any impact at all on the whole market. It may influence a specific segment of the market or a certain part of the financial markets. What we look at are the reports that have the biggest influence on the overall market. Economic reports reveal information about what has already happened. That's one of the problems that we're faced with when we're looking at economic reports. The stock market looks forward, but these economic reports look backwards. So they are called lagging indicators. However, an economic report can still have an impact on the markets. These impacts are usually short-term after they initially are released, and so that causes a reaction that will only last typically a few minutes, or it may help set the tone for that day. These reports also report longer-term trends that are discounted or baked into the market as they are released. We also have another thing called economic forecasts. Before each report is released, numerous economists make forecasts. One thing that you will notice is economists are kind of like weather people. Their reports can be right or wrong, but still, the market pays attention to what economists have to say. These forecasts are combined into a consensus forecast. So if you have 100 economists out there, and most of them say that this report is going to show growth, they'll take a consensus and say, most economists, or the consensus of economists, say that this report should show an advance. As these economists make their forecasts, this is discounted into the market. The impact, either positive or negative, does not necessarily come from what is reported, but from how far above, below, or in line the report is from the consensus estimates. So if economists had anticipated growth, but we actually saw a decline, that can have an influence on the market. It doesn't necessarily pay attention to the actual number. That's what the financial media likes to report and what you often read about. But what we're concerned with is Will this report catch the market off guard based on what it's already discounted? So now it has to re-discount this information, or will the market move along as expected? Now I'll talk a little bit about economic report releases. Most trading days have one or more economic reports that are released. You may read in a blog post or in videos that I do that I may say, today is a pretty light day economically, or there's no reports being released. Although those days can happen, they are pretty rare. Typically, each day will have something that is released. Other days will be filled with a lot of economic reports, and that can have a real influence on prices, especially in the short term. Economic reports are usually released at 8:30 a.m. Eastern Time, which is 7:30 a.m. Central Time, or 5:30 a.m. Pacific Time. If you like to get up early, generally what you'll do is you'll tune in as soon as possible to see what these reports have to say. Although there are exceptions to this time when reports are released, such as FOMC announcements. Those come at about 2 to 2:15 p.m. Other reports are released during the day, but the huge bulk of the reports that we pay attention to are at 8:30 a.m. Eastern Time. What can happen is this report is released about an hour before the stock market opens. You may be watching the futures prices and news from Asia or Europe, and it may not look like there's really going to be a big change from yesterday's close. Then an economic report comes out that is different than what the market expected, and we may see a gap at the open. The bond market has already had about an hour to digest this information. An hour after the bond market opens is when the stock market opens. So after a report is released, this can have a short-term impact on the markets. You'll see prices gyrate up or gyrate down. Typically, this can impact the open since the report was released shortly before the open of the stock market. A gap open may occur for several different reasons. This could be geopolitical news. This can also be domestic news, some kind of an event in the U.S., international stock market conditions, maybe something happened in Asia or in Europe that has an impact on the U.S. markets, and then the initial reaction to an economic report. Now I'm going to talk a little bit about how the financial media interprets economic reports. It's not as cut and dry as the media would like you to believe. So the financial media will almost always try to directly correlate an economic report with the results for that trading day. This is really interesting. A report is released, the stock market reacts, then it opens. So really there are three separate events. As the day goes on, if you tune into any of the financial channels, they make a closer connection between financial market prices and the economic report. And then by the end of the day, when they sum everything up, they say stock prices rose in response to today's economic report, where really the two happened far apart from each other. The markets tend to discount things immediately. An hour is a long time when you're talking about the financial markets. The stock market and other financial markets have had the whole day to react to this. So by the time we get to the close, the economic report that was released for that day is old news. But yet the financial media wants to make you think there was a direct cause and effect. This report was released and this is what the stock market did. That's why we watch the market all day. That's why I follow the market even when it's closed, to get more of a feel for how the market is reacting. Typically, you'll find that economic reports have a shorter impact than what you are led to believe. And as I said just a minute ago, it is rarely this simple. It would be nice if we could make a direct cause and effect relationship, but life just doesn't work like that. And even though the stock market is not complicated, with just buying and selling going on, price movement can be quite complex, and you can't make such a cut and dry conclusion. So making these same correlations should be avoided. I do videos every day and every week, and I will talk about an economic report that was released, and then I'll say, initially, this is how prices reacted, but by the end of the day, this is where we finished. So it's important to compartmentalize the different aspects of what are happening each day. Independent conclusions should be reached based on the tools that you use to analyze the financial markets. You might pay attention to a blog, or you might look at prices yourself. Take all of that information together and then reach your own conclusions. The market goes through different periods of time, known as good times, and then there are also bad times, just like the song. There are times when good news is seen as good news and bad news is seen as bad news. This makes sense to us. If there was a favorable economic report that saw an initial reaction where prices went higher, and then ultimately the market carried through until the end of that day, that makes sense. The opposite of that can also be true to the downside. However, this is where it can get a little bit tricky, and this is why it requires constant observation of what is going on in the markets. There are times when good news is seen as bad news, and bad news is seen as good news. The markets will fixate on something. Right now, as I record this, the markets are fixated on interest rates. Interest rates tend to go up as we see economic growth. If we see growth that is too strong, that can actually have a negative impact. The market is expecting growth, but if they see too much of a good thing and interest rates will be raised, that can lower bond prices, which can push up interest rates, which many times can bleed over into the stock market and have a negative impact that way. This changes all the time. A few weeks ago, a report came out that showed good strength, and the market ultimately went in a positive direction. Today, if that was to happen, and we see a strong economic report, that might send prices lower. So keeping up with what the current fixation is can be very important. This can change quickly, but can be better understood by watching the markets closely. That's why we watch things while the market is open and while the market is closed. Rather than applying logic to the markets, it is better to follow the market's logic. We may not agree with what the market is doing, but that doesn't matter. Price is price, and we have to follow that. This logic can vary significantly from conventional thinking or wisdom. We like things to be simple. A plus B equals C. An economic report is strong. The market likes that. Prices go higher that day. We want to be able to put things into a box. That's what the financial media does. But that box sometimes can be wrong. And the media won't figure this out until after it happens. We have to figure it out while it's happening or even see it before it happens. Now I'll go through just a list of some of the economic reports that we follow each month. For those that are members of the program that I teach, I do a monthly video just on economic conditions where I go through each one of those reports for the month and how things look, and then what we're looking at as trends going forward. The list below is not comprehensive. There are many more economic reports that are released than what I cover. I just try to go through and pick out the reports that actually have an impact. One of the things that is very important is GDP, the gross domestic product. This is the overall gauge for an economy. We have the US GDP, there's the British GDP. Every country has a GDP. If the economy is growing, the GDP numbers will go up. If it's contracting, the GDP numbers will go down. The definition of a recession is negative growth for 2 quarters. That's one of the things we need to be aware of with GDP. It's released every quarter. Now, there are reports that come out every month, the initial report, and then the first final report, and then the final report, and then the revision to the final report. So we get lots of information, and the market will react to all of these. Also, the employment figures. Typically, what will happen is the first Friday of every month, that's when the employment situation report is released. This is where we get the unemployment rate. and the average hours worked and the average pay. This is probably one of the most important economic reports released every month. The markets may be a little quiet ahead of this report because they're waiting to see what the report will say. Another thing that the Fed really looks at is industrial production. How are industries doing? Are they producing new products, building new things, or they're not building as many things, but they have a lot of inventory? This can be real critical for determining the current strength or lack thereof of the economy. Consumer spending. After 9/11, when the economy really had some difficult times, but yet we finally hit bottom in about 2003 and started to advance up until 2007, it was really the consumers who helped bring the economy back. A lot of people were refinancing at that time. They would take that money, go out and spend it, and that would help invigorate the economy. If people are spending a lot of money, that usually means there are good economic times. If they're not spending very much or they're saving more, that may mean that people are concerned and things are slowing down. We also keep a real close eye on inflation. Now, the bond market really pays attention to this, but because the bond and stock markets are closely connected to each other, we also want to keep an eye on inflation. As we come out of this post-pandemic COVID-19 situation, inflation has become a really big issue because we have the Fed who's been releasing trillions of dollars into the economy. We have the Congress who've been sending out stimulus checks and having all of this spending that's taking place. You have a new flood of dollars out into the markets. What's that going to do? At the time I record this, inflation is a concern, but it doesn't appear to be a real big problem. That could change in the future. And so we need to really keep an eye on what is happening with inflation. Home sales. In good environments, lots of people can buy homes or sell their homes. In bad times, people may try to sell their homes, but they can't necessarily find a buyer. So we watch the ebb and flow of home sales. Home building. A lot of companies, construction companies that build houses, if they're constantly busy in hiring new people, that generally happens under good economic conditions. The inverse of that is also true. Lately, what we've been seeing is a real increase in some of the materials that are used to build houses, like lumber. That's started to make front page news. If lumber prices become really, really high, that will probably stop home building because it prohibits the contractors from making a profit because they have to raise the prices so high that people can't afford to buy the houses any longer. We look at construction spending, not just for houses, but new buildings, bridges, roads. And then manufacturing demand. Companies have to produce products that people want. If there's a real demand for those products, those companies do good. If demand really falls, that's when you see layoffs and cutbacks and changes. Then retail sales, which is a very, very big part of the U.S. economy. Americans love to buy things. This has really changed a lot over the last 20 to 25 years as we've seen a real shift from retail stores that you actually visit to online stores where you purchase things and then have them delivered to you. We also saw a big change during the COVID-19 lockdowns. People couldn't leave their homes, so they would buy things online. And companies like Amazon, Apple, Netflix, those that provide products that are either delivered to your home as physical products or as movies or electronic books, saw real growth where a lot of the mom and pop stores that need customer traffic in order to exist really suffered. What you see right now is just an example. It's a generic example of what I do each week. I talk about these in the weekly and daily videos that I produce. And each week I come up with a spreadsheet. I get this from briefing.com, which is freely available. I take that information, I put it into a spreadsheet, and then I create this graphic. And each week, I'll just say, these are the economic reports that will be released. Over on the left, I have the day. I have some bogus dates in the next column, and then the time. I live on the West Coast, so I do things according to Pacific time. So you might have to adjust this for your specific time zone. And then what report is actually being released, and I have a list here. And then the next column over is what month is it for. So there's a considerable amount of time from what this report is talking about to right now. Then I look at the consensus. Briefing.com goes through and they survey a lot of different economists, and then they come up with a consensus amount. They may have a high, a low, a median, and a mean. And then over on the right-hand side is what the actual report said. And I have this color-coded, and I will explain what that means. The line that you see in blue, that means very, very important. During this particular week, on Wednesday, the 8th of July, at 11 a.m. Pacific time, that's when we had the release of the FOMC meeting minutes. Now, I don't have anything in the column because there's really no number to react to. These are words that are spoken, and the market will try to read secret meaning into those words and then possibly can gyrate up or down. Now, just to make it a little more clear, because I understand economics can be pretty boring. I'm an economic enthusiast, and I've taught some classes as a teacher on economics, but it's not my favorite topic. What I'm concerned with is, how do economics impact the stock market? And I don't really care. You'll find that a lot of economists have great opinions about things. There are different schools of thought. I learn about those different schools, but I don't really fall into one of those schools. I just want to know, if this report comes out, how is it going to impact the stock market? That's my bottom line. So the reports that carry the most significant impact are shown in bold or in various colors. Just for example, the actual column of the spreadsheet is color-coded, just to make it a little easier to read. White is as expected. So if we're in line with what the market was expecting, I just keep that number in white. If it's red, it's weaker or lower than expected. If it's green, stronger or higher than expected. And again, I'm just basing the number on what was reported versus what was expected. I'm not really concluding what the market reaction is. I talk about that in other ways, not on this spreadsheet. An empty column means that an event took place, such as the FOMC minutes that were released, which can cause the markets to react. The reaction was caused by what was said rather than by the release of any statistical report. So I hope that helped you and gave you a good overview of the different economic reports. If you want more information, I do teach about these things more in depth, but that requires becoming a member in my classes and in the videos that I do every day and every week. But thank you again for taking the time to watch this video. If desired, please click on the like or dislike. I don't know why I have to tell you this every time. It's like, you people are smart. If you like something, you'll click like. If you don't like something, you'll click dislike. I don't need to necessarily tell you that. Please leave any comments. That's what I really like to focus on, both positive or negative. Also, one thing that can really help this channel grow is if you subscribe to the channel. Again, I don't know why I'm telling you this. If you like the channel, you would subscribe anyway. As I talked about at the beginning of this video, there is a free workshop that you can watch. Also, there is the SPX Investing blog, which you can go to and read articles. Now, they're pretty much carbon copies of these videos, but I write in a different way than I speak, and so some of you might find what I write to be more beneficial for you. That can be found at spxinvestingblog.com. So again, thank you very much for watching this video, and I will catch you in the next video.